This is the Markets Club podcast with Jim Minter from Vanahn and Company and Greg McBride from Allendale Incorporated. We were talking about the fundamentals with the world supply and demand report. It's coming up from the USDA for tomorrow. We were talking about it with Greg and Jim right here on the Markets Club podcast. And then we were talking about the commodities index and demand for beef with Patrick Stoff from the University of Missouri. We will talk about the fundamentals with the world supply and demand report, an RVO introducing the BA with Jim Minter from Vanahn and Company and Greg McBride from Allendale Incorporated. Greg and Jim, how are you?
Doing very well.
Doing great, Caesar. Thank you.
Greg, let's discuss about the acreage report on last week. What was your thoughts with the corn acreage?
I think it was interesting that they did cut acres a little bit. Usually, when we have a quick planting pace, we do increase our acreage. But at 95 plus million acres, that's a pretty big number anyway. The biggest corn crop in quite a few years. So, not necessarily a surprise that it wasn't a bigger crop, but the slight cut will help us out on the ending stocks. Plus, when you look at this coming report, cutting the harvested acres might be the bigger thing to help us out. Maybe cutting 500,000 to 600,000 acres off your harvested number. That looks pretty good for us.
What is your position on the stock on the world supply and demand? You know it's coming out for tomorrow.
Yeah, I think the estimates are a little conservative. There's nobody's really looking for the USDA to make a change to the yields on this one. The idea is, they generally don't make big changes or make changes at all on the July report. They save that for August or September. It's hard to argue with not making a change with how good the conditions have been. But that'll be something to watch. The biggest thing I'm going to be watching is you've got a couple of things. You've got the size of the crop out of Brazil. We know that the USDA is somewhere around 131 million metric tons. Best guess is we're talking 132, 133 on this report. And that's still conservative versus what the guys down in South America are at. And then the other thing will be, what does the USDA recognize on the old crop ending stocks? Because we know that the export demand has been so gosh darn good. We've seen what I would estimate is 100 to 200 million bushels better than what the USDA is recognizing right now as far as our current pace. So do they make a big change there? Because that would actually just spin us more to the bull side and still have everybody kind of wondering why the funds continue to sell into this thing rather than maybe lightening up some of that short position. I'm not saying they have to go long, but maybe lightening up some of that short position.
And what is your thoughts on tomorrow's report?
Well, I thought Greg laid it out very nicely there. When you look to the foundation of where this corn market's at, I agree. It's the old crop usage. We know where, the supply has been for some time. It's the demand that has been so impressive. And when you see 110,000 metric ton sale to unknown base, really at this point, I don't care if it's, this coming year or even out to next year that we see some of these sales. To see this demand come in here with a big South American crop harvest, which is something we're going to be watching very closely tomorrow as well. I agree with Greg that, that 132, 133, I believe, is a path of least resistance of where we're looking at that corn production. And I look to that. I look at our demand. I look to the foundations that we've got through some of the feed sectors with a lot of these packers wanting these animals as big as they can get them. There's some nuggets here that the bull has yet. But again, with fund liquidation, with the farmer well sold, one of the biggest things that jumped out in my mind out of the stocks report was the fact that we are 16% less farmer held inventory than where we were a year ago at this time. And again, I think we're probably even greater than that. So again, the farmer actually sold that $4.50 to $5 old crop well. I think the details are for old crop here. Again, USDA has got to be convinced there's a significant change to change yield in the July report. Maybe they're there, maybe they're not. But, again, a lot of satellite imagery opinions floating around right now that are getting big on yields. And I think that's the big component that has got funds in the liquidation phase right now is the fear of that, as well as the fact interest rates aren't coming down. But I think we're in for a systemic change here with the way Trump keeps kind of pounding on Powell here, and knowing that about mid-May, we're going to see Powell out one way or the other. And Trump wants rates down at least 2 to 3% from where we're at right now. So again, it just added dynamics from not just a crop report, but the bigger picture of what we've got. So again, hopefully we can resonate with these funds finding their base bottom here in the next month. I'm hoping that this report, followed by the August report, get us to that point. And then it's going to take some work to build out of here, but I think we can as we work into those fall and winter months. So just take it one report at a time at this juncture.
Yeah, the corn crop is looking good, but the prices are currently unstable. This summer is extremely well as other than. What is the technical aspects, Jim?
Yeah, as I look to the tech aspects of this corn market, I mean, we've had price counts for now, 3 solid months that were pointing to 413 and 385 as the bigger downside counts. As we get down here, I'd like to include a 405 quant area in this as well. And what's really tough is we as analysts have to come here with opinions all the time on where this prices could go and whatnot. And from my vantage point, there's no way Greg or myself or whatnot are going to, verbatim know whether 415, 413 area is going to hold the support, 405, 385. But what we can do is start to change our posture and opinion as we see this fund short increase to 2, maybe 250, maybe to 300,000 short by the time we're done here. We can start looking at the seasonals where last year, if you look to July 15th to August 15th, we were able to round out this low between 365 to 385. So I really lean towards this $4 to 413 area as great initial support. If the yields are greater than 183, we start talking 184, 185, well, then maybe that 385 price comes in down the road. Otherwise, I think technically we're in a pretty good spot here. We're below 2 standard deviation from linear regression. You kind of got all the bear news we can throw at this with good weather, cooler temps, whatnot cast about this market right now. Again, I think technically, those are the price counts that matter. 413, 405 and 385. And we're really zoning in around this 4 to 413 area to make some posturing changes for our clients. Will that be the low? Time will tell, but that's where we're watching. The bean crop, I think, has more vulnerability. I'm actually, a little bit impressed that we're able to see the sell pressure with where bean stands are here, especially in the northern plains. But 1007 and 972 technically have been the important price counts that we are watching off the November beans, and I think we can hold there. There's a 915 that's down there, but boy, that takes some, negotiations with China to fall apart and some yields north of 52.5 to start talking, a 915. But 972 to 1007, we're into that ball game right now currently, Caesar.
Jim, I was out of the office. Can you tell us about the RVO from the EPA?
Yeah, so you got to love it when the EPA comes in here and scares the market with what was it, 475 billion gallon usage forecast. That was the proposal coming into the White House. Then we leave and we look at a 335 for 2025. But the big news was that 5.61 billion gallons for the 26 and then 5.86. So we're talking, bean oil. We're talking about the crush, that focus, but those were some much greater numbers than the proposals that went into the White House were at. So to see the market come out with those type of numbers, I mean, that oil market took off, meal plummeted, beans caught a bid. I mean, we made it all the way to 1060 prior to, this market kind of falling off on these good weather conditions and fund liquidation. But, the story's to be written yet. And what we've got to realize is, our crush has been strong to begin with. We know, that if the profit opportunity is there, we're going to grind these beans. But, now we put a RIN standard that needs to be met. So again, if we can get these all to stick, and again, I still consider them fluid anytime we're dealing with the EPA there. If we can get these to stick, we're looking at some very promising outlooks and some pretty good demand coming after the bean market as we work ahead. As for corn, the renewable fuel and ethanol, it's just a status quo right across the spectrum as we work ahead. Now, I will be watching to see what California does with their E15 standards. Some rumors that it's working through legislation there to possibly be a prospect to occur, and they're one of the last ones that don't have it. So that would maybe be news for ethanol down the road, but at least some good blending requirements if we can get this all to stick.
How about you, Greg? What is your thoughts with the RVO?
Yeah, I think the mandate was obviously surprising. We got excited about it a few months ago with the idea of 5.25 to 5.75 billion gallons, and then starting to see the numbers back off and getting a little bit concerned about it, but then getting the surprise. I think the big thing is that was only going to be bullish for a little while. It wasn't like we were going to go straight into crush and blow up the crush with that. Obviously, crush has been strong, like Jim said, but it wasn't going to be an immediate move. So it was only going to help us to a certain point. You saw, and you start to talk about the technicals. Well, you saw we went right back to that 1065, 1075 area on the market on the chart. That essentially took us right back to those highs from a few months ago, and that was where we stopped. Then we ran out of feed for the bulls, so we had to look for something else. I think this is still obviously going to be a massive deal. I think the potential for maybe turning some of that meal into exports to China will help out obviously on where we can take that because obviously we're probably feeding a little bit less on the animal side here as well. But I think the big thing that I take away from what Jim said as well is this ethanol side of things is not changing. There is no change there whatsoever. This is basically a steady Eddie for the last 3 to 5 years at 5.5. So we're essentially using a third of our corn for ethanol, and that's not changing. Even with some of these more recent reports being a little bit on the negative side, it's not going to change. And even if you do from a balance sheet perspective, we're talking maybe 5 to 10 million bushels in either direction. That's not really moving the needle.
How about the soybean crush from N? OPA on August.
Jim, you want to handle that, or do you want me to take that?
Yeah, Greg, go ahead.
Okay.
So, yep, go ahead.
Yeah, so crush. I mean, we talked about it with crush being strong. We've seen this year over year continue to increase, and even the estimates are now outpacing what we can even fathom. I still think that the crush continues to stay strong. Obviously, we've invested money into to upgrading or building new crush facilities. We'll continue to do that as long as there's an opportunity for it. There was a recognition from a few years ago, similar to the kind of move into to ethanol with corn, where we were producing soybeans at such a good rate, but the demand and the competition with Brazil makes us get to a point where we have to find a way to use or send or change how we do things, because we aren't going to be able to ship all of it to China. So switching off and crushing more and continuing to find usage, whether it's through veg oils or through biodiesel, renewable fuels, and that is a big deal for us. And I think that'll continue to grow. The August report continues to look like it's going to go in that direction. But I still think over the next, say, 3 to 5 years, the crush will continue to grow. We'll continue to bring new plants online, and whether we're putting it into airline fuel or we're putting it into diesel trucks or whatever, we'll continue to find ways to do it, because the actual raw bean demand to China is probably not necessarily sustainable, and we've already seen that start to decline over the last few years.
Yeah, we will see it on August. Okay, Greg, what is the technical? I talked to the beef specialist in Knoxville at the University of Tennessee. He mentioned that it's a pretty weird situation for the economy. What is your thoughts on consumer budget? Greg, really quick.
Yeah, I think the consumer is still willing to pay for beef. That might change depending on what happens with some of these tariffs and some of these issues here. But I would watch the tariff situation with Brazil. There's quite a bit of beef that comes in from Brazil. They're one of our top 15 or 20 trade partners, and if that beef slows down because of the tariff situation, that could put some stress on the packing industry here in the United States to keep up with some of that grind that they buy from Brazil. So that'll be something to watch. But overall, so far, just in the last 5 years, we've continued to pay up for beef, and I think it will continue to happen. And at some point, just like everything else, everything comes crashing down. But right now, it's still a bullish market that will stay bullish for a little while longer.
Do you have any final thoughts or recap of the acreage report and the fundamentals on the cattle markets, Greg?
Yeah, I think I'm going to say this, and I will probably be proven wrong because it's the USDA, but I think this is purely a corn report. Everything else that you're looking at doesn't look like we're going to have any major changes. You shouldn't have any major changes when it comes to soybeans or wheat. So on the corn side of things, it's going to be, what do they do with the old crop ending stocks, because that is going to have an effect on new crop as well. Do they make a change on the yield for this year's crop? If they do, that could throw things off, because nobody's really looking for that. There's whisper numbers out there, but nobody really thinks the USDA is going to step out on a ledge with this one and make that change. And then obviously, what do they do as far as the South American crop for that safrinha crop? Do they increase it? Does the overall corn crop come up to that 133, 132, 134 area, something like that? So it just kind of adds on to the world numbers. On the cattle market, I think there are some concerns, but just like what Jim's saying, it's a bull market. This is one of those markets that it can stay irrational for quite a bit longer than a lot of people can stay liquid in it. So one of the things you have to be careful about is just manage your risk. If you're looking at getting hedges in place or you're using LRP, just do it responsibly. Try and stay into to some puts rather than getting into a futures position that's going to continue to work against you. But the thing I would watch on this is the reason we've shut down that border once again is that screwworm situation, and as it continues to move further and further north, that's where you get the bigger concern that what if it gets into the United States? If it gets into the United States, that becomes a panic situation similar to what we've seen in the past with like BSE, the mad cow situation from almost 20 years ago at this point. And then the other one is, we mentioned Packers. We talk about the Packers situation. The thing that's going on here in the United States, we talk about politically or however it goes with immigration, if ICE raids continue to pop up, you get a situation where maybe some of your packing plants have workers that don't show up out of fear of ICE showing up, or they do start to do these raids and close it out. That's going to be a concern as well, because if you start to slow down the packing houses, or you run into a situation like what we saw with Tyson and Amarillo a couple of weeks ago, where they were ready to strike. That's another thing that any slowdown at this point could jam up the works and really make this market at least see a retracement. It doesn't necessarily change the overall fundamentals. We know long term this is still a friendly market for probably the next 12 to 18 months, whether from a production and supply standpoint. So if that's the case, you would be looking more for a correction than a complete change in trend at that point. But overall, this is still a friendly market, so it's got to be treated as such. Be very careful, but use your due diligence, because you know that if you are a producer, you have to make sure that you are prepared in case the market falls off. The other thing going for these cattle producers right now is just they've got cheap feed. Corn and wheat prices are very low right now, so that's helping them out. That's helping their bottom line to look that much better.
Thanks, you guys. We're running out of time.
No, that's great. Thank you, Caesar.
Thank you, Caesar.
Greg, pleasure.
Thank you.
Thanks, you got. This is Jim Minter from Vanahn and Company and Greg McBride from Allendale Incorporated. This is the Markets Club. We were talking with Patrick Stoff from the University of Missouri. I'm joining with Patrick Stoff from the University of Missouri in Columbia. We're having a conversation about the acreage report and livestock markets with Patrick. Hey, Patrick, how are you?
I'm doing well. Hope you have a good day there.
Thank you. Patrick, let's discuss about the acreage report. What is your thoughts on it, Patrick?
I think the biggest surprise was that there were very few surprises. For most of the major crops, the acreage that was indicated was very close to what had been projected back in the March acreage survey. That's not often the case, so that was actually news that wasn't news that was important this time.
How is the ratio of the corn?
I think on corn, we're seeing a lot of things happening at the same time right now. We have a lot of acres that were planted this spring. We've had favorable growing conditions so far, and the impact has been a sharply lower corn price. Unless we have some late season problems, I think we're looking at a relatively weak corn price for the crops harvested this fall.
All right. We were bringing in the corn markets. It's looking forward to seeing lowest prices on the corn markets. Do you have any concerns about this situation?
It's certainly a problem for corn producers, right? So these lower prices are not matching many people's cost of production. So producers will be reliant on government payments to make up at least part of the difference. The new farm legislation approved as part of the budget bill will provide some additional payments for the 2025 crops, but those may not be enough to make up the difference between costs and receipts for many corn producers this year.
Do you have any concerns about the fundamentals and technicals from the markets?
On the fundamental side, again, we just have a lot of corn. A big acreage planted. I think a lot of people expect that if nothing changes soon, we're going to have potentially record yields this year. So the combination of a lot of acres, a lot of production is a negative for the market. On the positive side of the ledger, the fact that export demand has been stronger than anticipated is a good thing. And so as long as new developments don't have a strong negative effect on the export market, That should help. Plus, the situation on the biofuel side is generally positive for the corn market.
Of course, we will see.
Of course, and things change on a weekly basis this time of year.
How is the reflection on the RVO situation?
So the RVO is positive for producers of both corn and soybeans in many respects. The level of that's made room for corn-based ethanol is the 15 billion gallons that many in the industry were looking for, and the numbers on the biomass-based diesel side are even larger than some had been anticipating. So that's been a positive for the market overall. There still remains some concern over whether these proposals will be finally adopted and whether any action that might occur in terms of granting small refinery exemptions might conceivably undercut some of this. But in general, though, this has been a positive for both corn and soybean markets.
How is the soybean oil markets for right now?
So soybean oil markets have tended to be pretty strong recently. They haven't had a big positive effect on soybeans because the increases in soybean oil prices have been offset by lower prices for soybean meal. So we need to crush more soybeans to be able to meet the demand for soybean oil to make biomass-based diesel. But that extra crush it means we have additional supplies of soybean meal, pushing down the prices for that product.
What about the livestock markets for right now with the fundamentals? Trade, labor, NWS.
Yeah, we were expecting a significant increase in cattle prices this year regardless, but the combination of events in recent weeks has pushed us to record highs in the cattle markets in the last couple of weeks. We have, on the one hand, very strong demand for beef, which is always a positive for the market. We have reduced imports of beef because of tariffs applied to imports from Brazil, from Australia, and from other countries. And now, of course, we have the concerns about the New World screwworm problems in Mexico that are limiting the imports of live cattle from Mexico. All three of those things combine to mean fewer supplies of beef in the U.S. market. At the same time, demand is strong, and that tends to push up prices.
Do you have any thoughts on the consumer budget might be tight?
Yeah, we just have seen some new numbers recently on the consumer price index, and on the food side of the ledger, most of the increase this past month was coming from higher beef prices. And so there's concern about, are these higher prices sustainable? Will consumers at some point pull back on their beef consumption because of these higher prices? And what does it mean for overall inflation in the U.S. economy, with impacts on everything from interest rates to value of the dollar overseas?
Do you have any final thoughts about the commodities markets in the growing season?
This is, again, the middle of the season yet, so there's still lots of surprises probably ahead of us. We'll learn more about the size of this year's crop in the weeks and months to come. It'll be very important to see the August production report, for example, that's actually based on real-world measurements and survey information, to see what that might tell us. There's always reasons to expect the weather and those crop developments to have a major factor. And of course, you've also got all the uncertainty on the trade front right now. Will certain proposed tariffs go forward? What sort of impact will those have directly on the market? And how might other countries retaliate against the U.S.? And what might that mean for markets could also prove to be very important in the weeks to come.
Thanks, Patrick.
Thank you for the opportunity today.
This is Patrick Stoff from the University of Missouri. Thanks to Jim Minter from Vanahn and Company and Greg McBride from Allendale Incorporated. This has been the Markets Club podcast.